Welcome to Hargreaves Lansdown's Meet the Manager. I'm Joseph Hill, and today I'm joined by Blake Hutchins, manager of the Trojan Income Fund, which features on our wealth shortlist of funds selected for their performance potential. So Blake, you run the Trojan Income Fund with quite a distinctive style, and that style is really quite different to lots of your UK income peers. So tell us a bit more about how you invest.
Thanks, Joe. We do take a different approach, and I've always termed it a quality approach to equity income, which is different to a lot of other styles in equity income. And what do I mean by a quality approach to equity income? Well, we really do spend a lot of time thinking about business quality. And I'd say there's really a hurdle in terms of quality which a business has to exhibit for us to be interested in them. I suppose in economic terms, in terms of the financial profile of these businesses, we're looking for companies that can do three things. Firstly, they've got to be able to grow. Equities have got to grow over time. We want these companies to grow while sustaining and enduring resilient economics. And if companies can do that, the second thing happens is that they generate a lot of free cash flow. And free cash flow really for me is the only source of long-term, I suppose, enterprise value creation, but it's also the only long-term source of dividend growth. So what we're looking to do is find 30 or so businesses that have these economics where they can grow at good economics, generate cash, reinvest some of that cash back into the business to keep that compounding going, but then very importantly, pay ultimately the end investor a growing dividend funded by growing free cash flow. And if we can find those businesses, and then this is the important bit, not overpay for those, then we think we're onto a good thing. So really, to summarize, it's all about the balance between quality and valuation. But where we differ from others is, I suppose, we have that quality hurdle, which we won't dip below.
And when thinking about how you want the fund to perform, there's two key things you target. The first is holding up better than the index when markets are weak, and the second is stronger dividend growth over the long term. So why are those two characteristics important to you in particular?
Well, I think the former, which is giving investors a smoother ride than average, is really in Troy's DNA. We started as a business in 2000 with the explicit intention of preserving and growing wealth in that order. So first and foremost, we don't want to be the fund that investors worry about when there's a difficult market or a market drawdown, which inevitably come. So that's the first thing. It's in our DNA. I think the second thing, I've always believed that equity income should be more in investors' defensive bucket, I suppose. We know that we're not going to be the only fund that investors own. And in the whole range of risk and reward out there, I do believe that those investors who like equity income, who like dividends, are looking for more of a defensive return profile. And when I think about the end investor and I think about the use of the fund, I think there's two main uses. The first is if you are looking for a growing income stream where you actually take the income today, where you'll buy the income units. And in a difficult market, in a difficult environment, you might depend on that income. So you don't want that income to disappear just when you need it most, and when the world around you is in a difficult place. And then the second use of the fund is if you buy the accumulation units, which is what I do with the fund. And there, it's very much providing the role of a defensive total return. And back to this point of compounding, or thinking about the compounding of returns, we all know that one of the biggest drivers of returns from equity markets over the long run is the reinvestment of dividends. And so again, when you get those drawdowns, when you get those better prices, you really want to make sure your capital's in place, you want to make sure the dividends are in place to be able to reinvest, or even, from my point of view, to be able to pivot into those attractive opportunities when you see better valuations. So I think one of the things that is very core to me, to my personality, to where I invest, which is at Troy, is making sure that that we do hold up better than most in a difficult market, so that we can enjoy the long-term compounding that you get when valuations are much improved.
And you've talked about your approach to investing already. Now, in recent times in the UK market, more valuation-focused approaches have fared better. So just interested in, as a portfolio manager, how you deal with those periods where your style's out of favour.
Yeah, I've always described myself as a quality investor with a very strong emphasis on valuation. I think what's interesting in the UK market, and I'm a big fan of the UK stock market as a whole, and the companies listed here in the UK, we actually have some fantastic businesses. We're very, very lucky, and I'm very lucky as an investor in the UK, that we have, in general, very high quality businesses. But we do operate with an unusual market structure. And by that I mean that the FTSE 100, which is a market cap weighted index, is quite heavily skewed by some of the biggest companies in the UK market. Just to give you a stat, the median company in the FTSE 100 has around a 7 billion market cap. But a company like HSBC, which is one of the biggest in the market, has a market cap of nearly 200 billion pounds. And so when you get times in markets, and interestingly, the US market is becoming a little bit more like that with the dominance of tech. But in the UK, when you see one of these big companies like HSBC, like Shell, like many of the other banks, perform very, very well, it tends to dwarf the return of the average company or the median company in the index. And so what you get is periods when value, or so-called value, can be very much in favour, and it drives the market in a way that isn't necessarily suited to our style. As I said, we have much more of a quality focus. So there's areas of the market that we just won't invest in. We typically don't invest in banks. We typically don't invest in oil companies. We typically don't invest in mining companies. We're not attracted to high levels of capital intensity, and we're not attracted to high levels of cyclicality. And instead, where we tend to invest in is some of the more cash compounding areas of the market, which, you're right, have not been in favour of late. And instead, the areas of the market that have really driven performance of the UK stock market have been those areas such as the banks, which are benefiting from rising interest rates and the like. So that can be difficult, and I think what's really important there is you're working at an organisation that understands your style, that reflects that style. And we do not invest relative to a benchmark. We try and construct portfolios from the bottom up, where we find those opportunities that we're looking for. And so that can mean that our returns can differ quite materially from that of the index, for better, but also for worse. And right now, as I said, in recent years, that has been for the worse. So how do we deal with it? Well, we try and recognise that when things are going our way, we're perhaps not as good as some people think we are. And likewise, when things aren't going our way, we're probably not as bad as the numbers may suggest at times. And instead, what we try and do is stick to our process. And the worst thing we can do is change our investment philosophy, change our process, which has been proven to work over time, just when we're at our most out of favour, because markets have a nasty habit of punishing you when you make those kind of trades. So yeah, what we try and do is, whilst always improving, stick to what we're doing.
And on that theme of sticking to what you're doing, you're employing that same process day to day as we speak. So what opportunities is that process throwing out at the moment?
I think the opportunity set in the UK is very broad. I don't think it's controversial to say that UK equities are on sale. And there's two big buyers in town today, which is one, companies themselves. 70% of our portfolio are currently buying back shares in themselves. They're doing buybacks. I think the number is about 60% for the UK market as a whole, which is a record high for the UK market. And then the second buyers are private companies or international buyers, and M&A in the UK market continues to happen. And it's not surprising, because I'll say it again, the UK equity market is on sale. So when I think about what we do about that, is we try and pick off these opportunities. There's a lot written in the press about how valuations in the UK are cheap. There's a lot written in the press about volatility in markets. But if you're a stock picker, which I am. I'm a bottom-up stock picker. I'm looking for individual companies that I think are high quality and undervalued. That's a dream environment for a stock picker. And so what we try and do is lean into those opportunities. And I think what I would say is that there are three big things that I think go in the UK's favour. The first is that, remember, the UK stock market is not the UK economy. We have the most international stock market in the world. About 80% of revenues from the overall UK stock market come from outside the UK. And we also have some fantastic UK domestic businesses as well. You'll see in the portfolio we've got companies like Next or Howden Joinery. Yes, they're UK domestic businesses, but they're fantastic businesses in their own right. The second point I would say is that, yes, we always trade cheaper than the US market. We're always at a discount to the US market, but right now we're at a material discount to our discount. And it's that discount to the discount which I think is the real opportunity, which maybe is 20 or 30% at a time when the US market is quite expensive. So I think that's interesting. And then the final comment I would say in terms of valuation and opportunities is that it's quite easy to construct a portfolio with a healthy dividend yield right now. And I think the UK stock market is the place to go for dividends. The dividend yield on the S&P is 1.3. You have to pay withholding tax on that. The dividend yield on our fund is north of 3%. That's twice covered by cash flow, and valuations are very attractive. So we're seeing an opportunity set across the market, and particularly across the fund. I think that's a good environment for stock pickers.
And reflecting on your career so far, Blake, what have you learned along the way that might have been useful to know back when you started?
I think one thing that you can do nothing about when you're young, which is inevitably, I suppose a weakness, is experience and perspective. You can only live the years you've lived. And I think the older you get, and I've now been doing UK equities for 18 plus years, is that sense of perspective is so important. And I think in particular, dialing out the noise, and understanding when you really do have to dial down the noise. And that's why I like to work somewhere like Troy, where we have a small team. We're not necessarily in the neighbourhood of all of our big competitors and the big houses. We've got quite a distinctive investment style. We're very patient, we're very long term, and we know what we're trying to do for our investors. So I think that's really important. And what I would say, and this is very true for the retail investor as well as for us, is that the noise is most alluring, it's most addictive just when you need it, just when you need to focus the most. And I'll give you an example is in the financial crisis, or when you see a big stock market drawdown, it's inevitable that the front page of the newspaper is suddenly talking about the stock market. The 6 o'clock news is talking about the stock market. And that's when you actually have to quieten down, you have to slow down, and that's your best opportunity for picking up great ideas. So I think I would say, recognize perspective, try and stay level-headed, and in particular, dial down the noise whenever you can, but particularly at those moments in markets when you have to do that most.
And who would you say has had the biggest influence on you as an investor?
Well, I've been lucky to work with many investors, and I am also an avid reader. I think when you read a lot about investment, and this I suppose comes back to my previous point about dialing down the noise, in a world today where we've got rolling news, we've got endless podcasts, I actually think going back to the basics and finding your key basic books or your key, I suppose, manuals that you believe in most, and going back to those every year or every couple of years can be so valuable. And when you read a lot, like I do, and I'm sure like a lot of your investors do, is so many reference Warren Buffett, and so therefore, everyone who's been successful in some ways has been influenced in some way by Warren Buffett. So you might as well go back to the source. And when you go back to the source of Warren Buffett, he takes you back to Benjamin Graham and even to other quality investors as well, like Phil Fisher. So I think there's no better place to go than going back to those founding fathers of the investment industry. But I also do believe that you can't read yourself to success. You have to actually get on the field and actually practically do this yourself. And so I think I'm very much a function of who I worked with in my first job and where I worked. So I joined the investment industry in September 2007 in the City of London at a graduate scheme at Morley Fund Management, which is now Aviva Investors. And when I was doing my studies for some of the exams, just around the corner on Moorgate, there were queues around the corner at the Northern Rock in Moorgate. There was literally the run happening on Northern Rock back in September or in the end of 2007 when I joined the industry. And so what ensued after that had a huge influence on me and how I invest. Balance sheets were important, cash flow was important, quality was important, dividend cover was important. And so I will always lean on those kind of metrics and always be that kind of investor. And the type of investors that I worked with in those days, they really did have that mix between quality at good valuations, and they've been very influential to me. So those are some of the things that I'd point out as big influences in my career so far.
And outside of work, how do you switch off?
Well, my main way is spending time with my family, and in particular my wife. We've been together for a long time, over 20 years, and before we had kids we used to travel a lot. I love travelling. I've lived in London all my life, as has she, and so when we get the opportunity to go to quiet places in beautiful areas around the world, we tend to do that. And the kids are now at an age where they're starting to be able to do that as well. They're 6 and 8, so I feel like we're kind of coming through the other side of that, which is good. And then aside from that, my big passion, which you may know, Joe, is tennis. I grew up as part of a tennis family. My father was a professional tennis player. I was one of 4 kids. My brother played professionally. Both my father and my brother represented Britain at Davis Cup. They played in all the Grand Slams. My sister played to a good level. My other sister played to a good level. And I play tennis to a good level, and I still compete at a decent level as well. So that's a way that I switch off, and it really, really helps at the end of the day when work is rattling around in your mind and then you end up playing tennis. You can't help but be distracted, and that's what you're thinking about at that time. So yeah, family and tennis are my 2 other passions.
Great. Blake, thank you very much for joining me.
Thanks, Joe.